In the bustling heart of New York City in 2010, Adam Neumann, a charismatic entrepreneur, launched a radical new vision for the traditional office space. WeWork promised more than just desks. It offered a vibrant, transformative community designed to elevate every member's personal and professional life. Adam, alongside his wife Rebecca, propagated a unique corporate culture fueled by grand pronouncements and a fervent belief in their world-changing mission. Early investors quickly bought into this intoxicating narrative, pouring substantial capital into a company that seemed poised for meteoric growth. SoftBank, led by the enigmatic Masayoshi Son, became a primary evangelist, seeing WeWork as a generational opportunity to redefine real estate entirely. Son's conviction propelled WeWork's valuation skyward, reaching an astonishing $47 billion by early 2019, making it one of the world's most valuable startups. The company expanded globally at an unprecedented pace, planting its distinctive flag in hundreds of cities and rapidly acquiring vast commercial properties. WeWork offices, often featuring sleek designs and endless amenities, attracted freelancers, startups, and even large corporations seeking flexible workspace solutions. Neumann's magnetic personality and boundless optimism became synonymous with the brand, promising an almost utopian future for the modern workforce worldwide. He championed a lifestyle that blurred the lines between work and play, fostering an atmosphere of constant innovation and communal celebration within their spaces. This aggressive expansion, however, relied heavily on short-term memberships and long-term lease commitments, a fundamental risk often overlooked by zealous proponents. The company's compelling narrative, expertly crafted and relentlessly pushed, overshadowed underlying financial fundamentals that were beginning to show strain.
Billions flowed in, creating an illusion of invincibility, enabling further audacious ventures and solidifying Neumann's position as a visionary leader. This era marked WeWork's zenith, a testament to the power of compelling storytelling combined with an audacious, world-changing, but ultimately fragile business model. Beneath the veneer of innovative community, a series of troubling financial irregularities and corporate governance issues began to surface. Neumann's personal lifestyle and professional conduct increasingly merged with WeWork's corporate identity, raising serious questions about accountability and ethics. Reports emerged of WeWork leasing properties from companies partly owned by Adam Neumann himself, a blatant conflict of interest generating significant controversy. He famously trademarked the We branding and then controversially sold its rights back to the company for nearly $6 million, sparking widespread outrage.
Lavish spending became a notorious hallmark, including a $60 million private jet for Neumann and extravagant corporate parties featuring high-profile entertainment. The community-adjusted EBITDA, a non-GAAP metric, was introduced to mask substantial losses, an accounting maneuver that deeply concerned financial analysts. WeWork's staggering losses grew exponentially year after year, exceeding $1.9 billion in 2018 alone, indicating a deeply unsustainable operational structure. The company's vision, once inspiring, now seemed increasingly detached from practical business realities, prioritizing buzz over bottom-line profitability. Rebecca Neumann's influence extended into crucial hiring and firing decisions, often based on subjective criteria, further eroding sound corporate governance practices. Investors began to scrutinize the company's reliance on a charismatic founder whose unpredictable behavior frequently overshadowed strategic business decisions.
Neumann's erratic public appearances and unconventional pronouncements, including aspirations for a $1 trillion valuation, started to alienate sophisticated institutional investors. Whispers of a toxic work environment and a cult-like corporate culture further complicated the narrative, contrasting sharply with the promised utopian ideal. The very structure of WeWork, essentially a long-term lease arbitrage business, exposed it to immense real estate market risks, despite its tech company self-description. Analysts pointed out that WeWork was effectively signing long-term liabilities while generating short-term revenue, a precarious position that intensified financial vulnerabilities. These escalating concerns culminated as WeWork prepared for its highly anticipated initial public offering, a move intended to solidify its financial standing. The moment of truth arrived in August 2019 with the public release of WeWork's S-1 filing, intended to showcase its financial health for potential investors.
Instead, the document exposed a deeply flawed corporate structure and revealed the extent of Neumann's self-enrichment and questionable governance practices in stark detail. Details about the founder's numerous conflicts of interest and the sheer volume of financial losses shocked institutional investors and the wider financial community. The S-1 document read more like a founder's memoir than a prospectus, highlighting Rebecca Neumann's role and the company's Elevate the World's Consciousness mission statement. Investors recoiled at the sheer audacity of Neumann's control, including supervoting shares ensuring his power remained absolute even post-IPO. The public market, unlike the private funding rounds, demanded rigorous transparency and a clear path to profitability, which WeWork struggled to articulate convincingly. Valuations plummeted dramatically from $47 billion, with analysts suggesting figures as low as $10 billion, a staggering repudiation of prior investor optimism. SoftBank, WeWork's largest backer, grew increasingly alarmed as the IPO prospects dimmed, threatening the massive investments already poured into the company. The impending public scrutiny intensified pressure on WeWork's board, forcing an urgent reevaluation of both its leadership and its unrealistic valuation. Major banks underwriting the IPO began expressing profound skepticism, indicating a severe lack of appetite for a company mired in such significant controversy. The narrative shifted from visionary disruption to cautionary tale, as financial media outlets dissected every problematic aspect of WeWork's operations and governance. This critical turning point marked the beginning of the end for Adam Neumann's unbridled reign and signaled an inevitable reckoning for the entire organization. The market's harsh judgment exposed the fragility of a business model propped up by venture capital and charismatic storytelling rather than sustainable profit.
SoftBank, facing immense pressure from its own investors, particularly its Vision Fund, was forced to confront the potential for a catastrophic loss. The once celebrated partnership between Neumann and Son began to fray, as the true extent of the financial liabilities became impossible to ignore or justify. Under immense pressure from SoftBank and WeWork's board, Adam Neumann was forced to step down as CEO in September 2019, marking a seismic shift. His departure, however, came with a controversial exit package reportedly worth over $1.7 billion, further inflaming public and investor sentiment alike. The eagerly anticipated IPO was officially shelved, leaving WeWork in a precarious financial state, desperately short on cash and facing imminent collapse. WeWork teetered on the brink of bankruptcy, its $47 billion valuation reduced to a fraction, highlighting the brutal efficiency of market correction.
SoftBank, to prevent its massive investment from becoming worthless, stepped in with a colossal $9.5 billion bailout package, effectively taking control of the company. This rescue mission averted immediate liquidation, but effectively nationalized WeWork under SoftBank's purview, ending its founder-led era decisively. Marcelo Clauer, a SoftBank executive, was tasked with the unenviable role of restructuring the now deeply troubled company, facing monumental challenges immediately. WeWork embarked on a drastic turnaround, implementing severe cost-cutting measures, selling off non-core businesses, and laying off thousands of employees globally. The company slowly began to shed its controversial past, striving to become a leaner, more traditional real estate company focused on operational efficiency. In October 2021, WeWork finally went public through a SPAC merger, achieving a significantly reduced valuation of approximately $9 billion, a stark contrast.
This drastically revised figure represented a profound recalibration of market expectations, emphasizing profitability and sustainable growth over audacious vision.
The WeWork saga remains a potent cautionary tale for investors and entrepreneurs alike, illustrating the perils of unchecked ambition and flawed corporate governance. It highlighted the critical distinction between private market euphoria and the public market's demand for rigorous financial discipline and transparent accountability. The company, though chastened and transformed, continues to navigate a challenging market, striving to prove its long-term viability without its charismatic founder. Adam Neumann, despite his controversial exit, emerged from the wreckage personally wealthy, a stark outcome for the architect of such significant corporate turmoil. WeWork's downfall serves as a powerful reminder that compelling narratives, no matter how grand, cannot ultimately substitute for fundamental business principles.
The story underscores the indispensable role of due diligence and robust governance, preventing excessive hype from blinding even the most sophisticated investors. It forced a critical reevaluation of venture capital practices, particularly the propensity to fuel unsustainable growth without clear paths to profitability. WeWork's legacy is etched into the annals of modern business as a stark example of a multi-billion-dollar startup that spectacularly imploded under its own weight. The saga stands as a monument to the intoxicating allure of disruption, yet simultaneously warns against the hubris that can accompany such revolutionary aspirations. Its trajectory showcases how quickly market sentiment can shift, transforming a darling of Silicon Valley into a symbol of corporate excess and financial misjudgment. Even today, the echoes of WeWork's rise and fall resonate through boardrooms, prompting deeper questions about founder power and investor responsibility.
The experience reshaped how private companies approach public listings, fostering greater caution and a renewed focus on sustainable, tangible value creation. This dramatic narrative illustrates the delicate balance required to innovate responsibly, honoring both the vision and the essential financial realities of business. WeWork's journey from a $47 billion darling to near bankruptcy embodies a unique chapter in the history of overvalued startups and their inevitable corrections. The lessons learned from this spectacular unraveling continue to inform investment strategies, emphasizing fundamental metrics over speculative, hype-driven valuations. Ultimately, WeWork's tale remains a gripping testament to the seductive power of ambition and the brutal consequences when reality finally catches up to the dream.